Hey, good afternoon, everyone. Hope everyone having a good weekend. So, right, one of the best ways to make money in trading is we can trade earnings. So, with earnings, there is a high possibility, high potential to make money if we use proper strategies or proper tools. So, let us understand what are these earnings, how to create income, how to create a second side hustle using earnings. So, first of all, we need to, right, let us first discuss about the concept and then let us look at examples so you will understand better. So, what are these earnings, right? As per the regulations, at the end of every quarter, that means every 3 months, all these public listed companies, like whether it is Nvidia, Tesla, Google, Microsoft, there are thousands of companies, right? Publicly listed companies. They need to report their earnings to SEC, right? They have to tell how much profits they made, how much earnings they made, what is their future guidance, what they are planning to do in the next 3 months, what is the earnings per share, all the details they have to publish, right? So, so that they can uh, continue their operations. If some companies fail to do that, then these SEC may remove the permissions, remove them, so that they cannot raise any more money from the stock market. So generally, these companies for every 3 months they do the earnings calls, right? Earnings reports. They do either before the market, that means before 8:30 a.m. Central, or they do after 3 p.m. Central. So every 3 months, this is a cycle. This keeps going on, right? They don't stop at one point, right? Every 3 months they have to this. This is a continuous process. So generally, whenever they report earnings, if the earnings are good, if their future guidance is good, the stocks can move so much high. Or if the earnings are bad, sometimes even earnings are good but the expectations are so much, but the profits are, right, for example Nvidia, the expectations were so high, but they did not, even though they beat the expectations, they made nice gains sometimes, right? For example, if you expect so much from your favorite movie star, if the movie is okay but if it is not so good, you may get disappointed. In the same way, if the company reports positive earnings per share with a good guidance, but still some, especially the big companies, will have more expectations. So based on all those factors, we can trade uh, earnings in three different ways. So generally, you can do with options, you can do with stocks. With stocks, your risk is minimal, right? Because stocks there is no time decay, there is no expiry date. If you buy some Nvidia stocks now, it may go down next week, but after 1 month, 2 months, it may go up. So overall, your risk is minimal. But options, unless you use proper strategies, you have high risk. But if you use proper strategies, you have much more potential because with a low investment, you can make more money. And for earnings, you can make money in three different ways, right? One is you trade much before the earnings date, right? For example, if earnings for Bank of America or JP Morgan or Wells Fargo or Citi Financial Group or BlackRock or Tesla, Nvidia is going to happen in next 3 weeks, 4 weeks, 6 weeks, you can do certain strategies. Or there are you can do one just 1 day before the earnings, or you can do after the earnings. So there are three different ways you can do. You can trade for the earnings. One is much before, right? Nearly 3 to 4 weeks before itself, you can trade the earnings. Second is just 1 day before. That means if some company is reporting after hours, or if some company is reporting on the next day morning before market open, you can trade them today at around 2 o'clock, 2:30 before, right? Because market closes at 3 p.m. Central. So if any company is reporting today after hours or tomorrow before market open, I can trade some of those companies so that next day morning, if your expectation is right or if the company is moving as you expected, you can make nice profits. Because whenever they report earnings, suddenly the stock can move so much up or so much down. If you are bullish and if stock goes so much up, you make nice profits. Or if you are bearish, stock goes so much down, you will make huge profits. Within one day, you can make 100, 200, 300%, such type of returns. Or there is one more strategy where once the company reports the earnings, now you know what is the probability, well, right? Whether based on the how the company reported earnings, all those things, the trend can continue for 2 3 days. So you can also trade based on the earnings for next 2 3 days. So these are the three different ways we can do. So let us discuss about one by one each strategy, how to do. If you are trading 4 weeks before, how to do. If you are trading one day before the earnings, how to do. If you are trading after the earnings are declared, how to do. So if you are generally there is right for every option premium, there are multiple components called. One is called as intrinsic value. That means based on the price of the stock, you have certain values, and based on the theta, right, the time value, implied volatility value, also the price, the option contract is priced based on multiple factors. So, especially for some very good stocks, right, like Tesla, Nvidia, Amazon, Google, Microsoft, AMD, QCOM, such type of well-known companies, big companies, generally there will be a lot of anticipation, right? There will be a lot of hype around those big companies. So 4 to 5 weeks before, the hype will be less. But as you are going more and more close towards the earnings, the hype will go up more and more. The implied volatility will be too much, right? Because there is a lot of anticipation, there is a lot of hope. Microsoft may do something with uh, right with that new products, or Apple may do something good, or Amazon may do something with AWS. Nvidia may do come with some new set of chips, BlackRock chips or something like that. There'll be a lot of anticipation, so the price, the option contract price will keep going up close, right? When it is close towards the earnings, the price will be much more higher. When it is little away from earnings, the implied volatility will be less, and it will be so just like, right, for example, if there is a cricket between India Pakistan, right, people before 5 6 weeks the prices may be little less, but as you get close and close to the match, the prices will be so much high for the tickets. In the same way, the option calls pricing also will be so much before, especially 1 day 2 day before the option, right, the earnings date, it will be so much high. So we want to take advantage of that implied volatility, because that IV is the significant component of the option contract price. So one is based on the price of the stock, one is the theta decay or the time value, the third one is the implied volatility. Because right at earnings there will be too much of volatility. There will be a lot of up and downs. So because on the earnings day it can go up so much high or it can go down so much low. So that's why there will be a lot of hype, and the IV will be very very high. So if you want to do the first strategy, the first thing you need to do is you need to understand which are the best companies, which are some of the top companies, which companies have a lot of hype in the market. Right? For example, now there are a lot of AI based companies which have a lot of hype, or Nvidia has a lot of hype, right? Or you, if you see AMD, or right, lot of chip based companies have a lot of hype, or Microsoft, Google, Meta. These are some companies which have a lot of hype. So you have to understand, right? For this strategy, we mainly focus on good companies, hot sectors which are hot in the market, and then generally the stocks which are moving good, right? Which are outperforming the S&P index, which are outperforming the Nasdaq index. That means if S&P is moving 5% or 6% in 2025, Meta might have moved 10%, or Nvidia might have moved 30%, 40%. That means they are much more, making much more growth compared to the overall S&P. And then wherever there is hype, and also if they are making good moves in the market. And there is also something called as a six-star setup. So if we have six-star rating or a six-star, again, which our tools will help you to know which companies have that six-star setup. So those are the best companies where there is a lot of hype or where there is a lot of potential for those stocks to go up, right? So again, this is right. We are talking about the first strategy where you are not waiting until the last day or day after the earnings. Before 4 weeks itself, you want to identify which stocks are best or which stocks you can buy the calls now. You can do bull puts now. Those that is the strategy. So we can go to one of these links, right? Whether you can go to trading view stocks earnings, you can know which stocks are going to report in the next 3 to 4 weeks. You can go to yahoo.com, right? For example, let us go to yahoo.com. So if I go to earnings and I want to trade, all right, I want to buy some stocks or I want to do some options for which the companies are reporting after 3 4 weeks, right? For example, now we are in September first week. I want to see somewhere in, right, now it is September 7th. I want to see, okay, October 7th. Okay, these are not some very well known companies, right? On October 7th, RGP. So now if I go to October 8th, okay, I see not very good companies. October 9th, I see that, oh, Pepsi, PEP is a well known company. Delta Airlines, well known company. Domino's Pizza, well known company. Then you have APLV is well known company. Not so much, but it is okay, right? And then if I go to October 10th, BlackRock is a well known company, right? Financial company. Okay, October 14th, JP Morgan, very big company in the banking sector. Johnson and Johnson, very big company in the healthcare. Goldman Sachs, very big company. Wells Fargo, very big company. Citigroup, Charles Schwab, United Airlines. So I am trying to, right, for the first strategy, you want to take advantage of that hike in the implied volatility because the premiums will go up so much around this time frame. Right now, the premiums will be less, but around this October first week, the premiums will go so much high. So now, if I want to do some swing trades, this is the best time. But we need to find out which companies out of there are so many well-known companies, but out of these companies, we have to find out which ones are the best. So we'll use some indicator called the pre-earning scanner, where I can put those names, right? For example, Wells Fargo or Citigroup, Wells Fargo, Bank of America, JP Morgan, right? United Airlines, Delta Airlines. So these all these companies are reporting in next 4 to 5 weeks. What are the other companies we saw? Um, okay, Pepsi. We saw Pepsi, and then Domino's Pizza. Just we'll put some Tesla. Like that, you can include all the companies which are reporting in next 4 weeks. And then you can see that out of them, there is a lot of hype for J&J. Right? There is nearly 6 rating, and all the six are very good. Tesla, it has a good rating. Domino's Pizza 5 star. United Airlines 6 star. Wells City Financial Group 5 star. Bank of America 5 star. Wells Fargo, even though it's a good company, it is not meeting the criteria. JP Morgan not meeting the criteria. Pepsi not meeting the. So we can establish which one has more potential to go up. So by using the pre-earning scanner, it will tell us which companies are best to best to buy the calls or best to do the bull puts. So what we are doing, we can go to one of these websites and we can find out which companies are reporting next 4 to 5 weeks. And then when we give all the input of those names, then that will tell you Adobe is having very negative rating, not a great potential for Adobe. For Oracle also there is not much. GameStop also it is not great. Micro MU it is having a good potential. AutoZone having a good potential. CCL. So that means the wherever you see 5 star, 6 star, those are the best companies where we can either buy the calls, right? Swing calls for October 15th time frame. You can buy the calls now itself. Or we can do call debit spreads. So that means you buy some uh, call and also you can sell a higher strike call. So that is the first strategy where all what we are doing, we are looking at very good companies, hard sectors, which are doing outperforming the market and using the 6 star setup indicator. We are finding which are the best companies to trade. And then once you identify them, you wait for a pullback on those companies, right? For example, let us say Micron is a good company, right? Micron has a high potential. So what I'll do, we'll go to Micron. I can go to 1 hour time frame. So Micron is already at a peak now. So we have another 2 3 weeks for Micron earnings. So you don't want to buy calls at the peak. You wait for a pullback. Whenever there is a pullback, right, there might be suddenly some red day for Micron. If Micron comes around this 126, 127 area or 124 area, that's a good time to buy the calls. Then there is a high possibility it will go all the way to 136 before earnings. So I am identifying what are the hard sectors. I am identifying which has 5 star, 6 stars. Out of them, if the stock is already at a peak, don't go and buy a call tomorrow morning for Micron because it is already at a premium zone. You don't want to buy at the top. You wait for price to come somewhere to the midpoint, right? This is the equilibrium zone. That means it is a fair value price. You wait for the fair value. Price will never go one way, right? It will go up, come little bit down. Again go up, come little bit down. Again go up, will create higher highs, higher lows, higher. So before earnings, it may go all the way to 136, where sellers are waiting. So now, whenever you have a pullback, if I buy a 125 call, and within 1 week, 2 weeks, 3 weeks, if it goes to 135, 136, you can make nice profits. So you are not depending on the earnings, what will happen on the earnings day, because there is always a hype before the earnings. You want to catch that hype. You want to take advantage of that hype before the earnings. So because Micron earnings is somewhere, so if you see Micron earnings is on 23rd September, that means another 2 3 weeks. Whenever we see a nice pullback on Micron, if it comes to $124, we can buy calls, 124 call, 130 call. You can buy a naked call. Or You can buy 125 call, you sell 135 call, because you know there are a lot of sellers here. So you are doing a debit spread, and you can, if price goes to 135, so here instead of investing big money, you are also selling a call, so your investment is getting reduced. You are buying a call, you are selling a call. You can take advantage of both the sides. So that is how you can make money before there, right? Irrespective whether it report good earnings, bad earnings, whatever happens, you will make nice profits before the, you will close one day before the earnings. If the micron is reporting on 23rd, on 22nd itself, you can close the trade. So whenever there is a pullback, you buy the calls. Whenever you see nice 50%, 100%, or you wait until one day before earnings, or if it is reporting today afternoon, at the end of the day, you close the trade. You can close 90%. If you want, you can hold one or two contracts and you can close everything else. You can make nice profits. So is it making sense? So we are looking at good companies. We are looking at 5 star, 6 star rating. Whenever you identify something, for example, United Airlines. Right, United Airlines has lot of sellers here. So it may touch that, do a pullback, come back somewhere 102. Whenever it comes to around 102 area, there are a lot of buyers here. So we can buy calls here. You can buy calls, and then earnings is on 21st October. That means you have nearly 5, 6 weeks. So you can make nice profit on United earning calls, right? Before earnings, it may go all the way to minimum $116. So first it will do a pullback, wait for a pullback to enter the calls. Now there are some sellers. Whenever it does a pullback, you take the trades 3 to 4 weeks before the earnings, and then by earnings it may go all the way to $115. So that is the strategy where we look for the 6 star rating or five minimum 5 star rating, and only buy those companies calls or debit call. You can do naked calls, right? You are not doing the same day call, so even if it stays choppy for 1 2 days, you don't need to worry. You are doing swing trades for next to 3 weeks, next to 4 weeks. You are doing a swing. You are buying a naked call. So right, here you don't need to worry what will happen if it stays choppy, right? Only for SPX we are doing credit spreads because we are mainly taking zero DTE, one day expiry. Suddenly if they become choppy, you want to take advantage. But here you are, if the earnings is 1 month, 6 weeks from now, we are taking the trades now. So here you can do the swing trades if you have a 5 star or 6 star setup. So that is about how to trade earnings 5 to 6 weeks before. So generally, the chances before the earnings is less, right? The chance of stock assignment before the earnings is minimal. Only once the earnings is done, they may assign the stocks, but before the earnings, the risk is very, very minimal because you are taking October 15th expiry or something. So now let's going back to, so that is the first strategy where whenever you identify good companies like Micron or United Airlines, you wait for a pullback. You can do directional naked calls with a 70 delta calls with 3 to 5 weeks before the report. If it is within 2 weeks, you do 30 delta to 50 delta. That means you are buying somewhere close to the price. 70 delta means you can even do in the money calls. That means if Micron is 110, you can even buy 115 call. You can also do debit spreads. Then generally 2 to 3 days before the earnings, you can take the profits. Then the another strategy, which most of the time I use, generally just before the earnings. So if earnings is today end of the day or tomorrow morning, then generally we trade 20 to 30 minutes before the market close. So you have high risk and high reward because, as I said, sometimes even the company reports good earnings, price can drop if the expectations are too high. Sometimes company report bad earnings, but if the expectations are so low and company report little bad, the price can go up. So anything can happen. So trading 30 minutes before the earnings has high risk and high reward. So it can make 200, 300%, or it can also become zero. So generally we use vertical spread and butterfly. These are the best strategies. Instead of doing a naked call, naked put, the you can do bull puts or bear calls or butterflies. If you are bearish, you can do bear call. If you are bullish, you can do bull put, or you can do iron fly strategy, butterfly strategy. But yeah, we generally use, right. For example, right. Let me explain some examples. We took some trades in the last week. Right. These are the we took AVGO trade. We took bull puts for AVGO. Right. AVGO sell 320 put, buy 315 put. So we are not doing naked calls because anything can happen. But when you do bull puts, if it is looking bullish, if it is looking 6-star rating, then you can always go and do bull puts rather than buying a naked call. Um, for example, CRM, right? Let me show you why we took CRM. So, so this is our T55 indicator. Generally, if you are below the support before the earnings, there can be a huge upside move, right? If you are above the resistance, right? When CRM reported on, when was CRM? Yeah, CRM reported on September 2nd or something. So it was right completely above the resistance. When price is above the resistance, whether it is daily or 4 hours, if price is above the resistance before the exactly before the earnings, there is a high possibility for a drop. Price is below the support before the right 30 minutes before the earnings, there can be a huge potential for a bounce. Right? For example, if I see AVGO was close to the support. That means there can be a huge potential to go up. So if we take some more examples, right? We took bull puts for Baba. It was close to the support. Before earnings, if it is close to the support, there is a huge potential for price to go up. If it is close to the resistance or above the resistance, it is much better opportunity. If it is below the support, it is much better opportunity. So every day you have 20, 30 companies reporting earnings. So out of those 20, 30 companies, if you see one or two companies below the support, one or two companies above the resistance, you can either do bull puts, you can do bear calls, you can do butterfly, and you can make nice profit. So that is one more way where we use our indicators for earnings. Right? One way is you can use different indicators for SPX, you can make profits. You can do swing trades, you can do zero DTE, you can do 1 day, you can do 5 days, or you are a busy professional, you don't have a lot of time. Just before last 30 minutes, you come and see, okay, is Baba close to the support or close to the resistance? Is CRM close to the support or close to the resistance? And here you use daily time frame. If it is above the resistance, that means it already moved so much in last 1 month. Right? It will, with earnings, there can be again lot of big move. Already it right, it made such a big move from $200, or yeah, it right, CRM from nearly 230, it went all the way to 260 or something, or yeah, it moved all the way to 275. Then there was a huge drop to $230. So like that. So one is your T55 will help you. Second is your price pulse. So you have indicators like if you have a lot of buyers here, that means CRM can again start moving up. So that is the second way, right? One is right. The first way is where you trade before 3 to 4 weeks. You identify good companies. You identify the 6 star or 5 star setups. That and you trade them 3 to 4 weeks before itself. That is the first strategy. The second strategy is you trade the earnings report. You use price pulse T5, T55, and also pre-earnings scanner. If that shows still very bullish 6 star, then there is a high possibility for it to go further up. So vertical spreads and butterfly, these are the best ones because naked. If you do naked call, naked put, it can because the IV will be very very high, right? Implied volatile. That means you will buy your premiums will be very expensive when you do the when you buy a naked call or naked put before earnings. Your cost of the contract premium will be very huge. Suddenly, if it stays choppy, right, even though it may not go down, it may not go up. If it stays choppy, also, you will lose a lot of money. But when you do bull puts or when you do a butterfly, if it stays choppy, also you will make profits. So that's why for 1 day before, if you are trading the earnings, then you do vertical spreads or better, right? We did Nvidia, we did a butterfly, right? It stayed choppy, we made nice profits with that. So generally we do bull puts or bear calls based on the bullish setup, bearish setup. We made nearly 85% success in all August with all the earning trades. Then another one is you can trade post earnings, right? Once the earnings is over now, right? Already company reported earnings. Then we can use stock level manager, T5, RLM to trade. Generally, most of the time, what will happen is, for example, let us take AVGO. If a company reported good earnings 1 day before, right? On this day, AVGO reported very good earnings. Then there was a huge gap up, right? You use the buy signals, right? That means it is very bullish. Whenever you see a buy signal, strong buy, you can buy the stocks. You see a sell signal, you can avoid. Again, you got a buy signal, you can go long. You see a buy signal, you can buy the option calls. You see a sell, you can avoid. Or you just close your long trades. Like that, if a company reported positive earnings, next day you focus on the buy signals. If a company reported negative report or negative earnings like CRM, then you focus on the sell signals. Yet immediately after the earnings day, next 2 days, 1 day, they will continue in the same trend. They will continue to go down further. Got a sell signal. So next day morning, market open, you got a sell signal. Again, there was a huge drop. You got a buy, you can ignore it. So that is one more way where So for earnings, there are three different ways. One is 3 to 4 weeks before the earnings. One is one day, or if it is after hours or pre-market, you can trade them today. Today between 2 to 3 p.m. using the T55, using the T5, using the price pulse, all those indicators. If there are a lot of, you see a lot of buy blocks, right? Let us see in the daily. So here before, right, you see a lot of sell orders. Right? Price pulse will tell you what big companies are doing. If you see a lot of sell orders 30 minutes before earnings, that means big companies are planning to sell it off. That means they might have got some insider information, or they might have some other tools or some other ways to know what can happen with the earnings. So price pulse also will give you this indication whether there are a lot of sellers are selling. And after the earnings, there will be a big drop. And then whenever you see big companies are buying, again you can do bull puts, you can buy naked calls, you can buy the stock like that. So this is how you can trade earnings 4 weeks before, how you can do, one day before, how you can do, and once the earnings is over, how you can trade. So like that, all different ways you can, if you have good tools, good, you take time to learn, practice, then definitely you can make nice gains. And you don't go all in with one trade, right? Don't try to make all the profits in one day. Always divide your portfolio into 25, 30 parts. Use one part for each trade, because even if one or two trades go wrong, with other eight trades, we'll make profits. And that is the most important rule in trading, because there is no strategy or there is no tool, there is nothing, no analyst where there is always 100% success. There will be always, if you can make 70% success itself, that is good enough if you use proper position size. Yeah, you can also do sell puts while you wait for a pullback. There's no snow. You have a resistance at $250. So there is a pullback now, and again it is trying to bounce. It may do a double top. It may go up again to this 250 plus. Yeah, Oracle is looking as of now. There are a lot of sellers here. Oracle is looking bearish for the earnings. Oracle in one star, so yeah, chances are very high for it to report negative earnings. So yeah, again, right, we cannot look at hundreds of figures now, but I hope you all got the concept how to trade earnings 4 5 weeks before, how to trade one day before, how to trade one day after. So you can use different strategies, different tools based on where you want to take the trade. If you are doing 4 to 5 weeks, you can do naked calls, you can do debit spreads. If you are doing one day before, vertical spreads, which are credit spreads, are best, and the butterfly. If you are doing after earnings, then again you can do bull puts or you can do naked calls based on the earnings report. So Yeah, again, right, all these are custom indicators. We developed the software, we did back testing. So yeah, you can go to the website, you can subscribe to these indicators, and you can also join the live sessions. You can join the live sessions, learn, you can take the trades in the live sessions. Because the tools will make your job more easy. Instead of going through hundreds of things, your scanners will tell you which is most bullish, which is most bearish, which is 6 star, which is 1 star. So that instead of losing money in trading, you spend some money in your education, in your learning, in your tools, so that you can make 80-85% success with all your trades. So, right, again, there are some indicators which are good for SPX. So you have to decide if you like SPX trading, you don't want to focus on so many different tickers, then SPX is the best strategy. You want to take advantage of earnings where there is a huge potential for a big move up, big move down, then earnings indicators are best. Or you want to mainly focus on prop firm trading, right? You don't want to invest your own money. You want to take advantage of prop firms. Then you have a set of indicators which will help you to do ES or NQ, GC, CL. So we have RLM, FLM, E5 or MTF scanner. So where we have a session at 6 p.m. where I explain, we'll also do live trades. Every day evening we are making 500, $600 every day within 1 hour in each of the prop firm account. So if you have five prop firm accounts, you can make 500 into five. If you have 10 prop firm accounts, 500 into 10. So that is another. So it is up to you, right? Whether you want to take trades in your personal accounts, then SPX indicators or earnings indicators. If you want to do prop firm trading, then that set of indicators. So it is up to you. Whichever you want, you can lease those indicators. Initially, you can join the sessions, take the trades. Afterwards, you can do by yourself. You don't need to depend on me because now you have all the tools. You can trade once you become independent. You can trade in midnight, you can trade in mornings, you can trade whenever you want. You will be able to use the indicators and trade. You will become 100% independent. Yeah, GC as of now is bullish, but yeah. So yeah, I'll share the recordings of both the sessions. You can watch, you can understand. And with SPX, we are making 80-85% success. With earnings, we are making 85% success with the help of all these tools. So yeah, we'll have another session at 6 p.m. for the prop firm trading. Yeah, we have daily setup session or every 2 days we have setup sessions where we help all the members on how to set up these indicators, how to use them like that. So once you subscribe, we will help those new members. Every 2 days we have a setup session. With debit spreads, you have more advantage to make more money compared to what was the other ticker, which was okay, Micron. Right, for example, Micron. When you do a credit spread, you have low risk and low reward. When you do debit spread, when your direction is proper, when you have lot of confidence, when you do debit spreads, you have more profits. You can make more profits. So that's why when the confidence is strong, we can take naked calls or we can do debit spreads. When you want to take low risk, you can do vertical spreads or you can do bull put spreads like that. So based on the confluence, based on the fact, because Micron we have 2 to 3 weeks and it is very bullish. It is a 6 star rated or 5 star rated. Whenever you get a pullback, if you buy the calls, you have more possibility to make bigger profits with a debit spread. rather than a credit spread. So you want to do credit spread when you have high implied volatility, right? Before the 1 day before earnings, your IV is so high. So you want to do credit spread at that time because even if stock stays choppy, because of the IV crush, you can make nice profits next day. Whereas 4 weeks before, your IV is very low. So you want to take the advantage of the say, increasing IV. So that's where you do a debit spread rather than a credit spread. We will help with all the indicators and then yeah, in the live sessions you will understand why we are taking some futures or some stocks and then you can do everything by yourself. Prop firms are companies which are ready to give you capital to trade, but before they give the capital, they want you to prove whether you can trade with the proper discipline, with a proper system. Once you prove that you can do that, then they will give you the capital to trade. You don't need to use your own money, and there is no liability or something. Even if you take losses in their accounts, again they have a limit, strictest like stop loss. Once you lose 3,000, 4,000, the account will get locked. So if you make profits, you can keep 80 to 90% of those profits. So that is where you don't need to invest your own money. You have to just use the tools, use the right proper trend. You need to identify which is bullish, which is bearish, and then if you take the trades, you don't trade which are in a choppy or which are in range. You look for very bullish or very bearish, and just focus on the ticker, make some profits, and stop for the day. In the evening time, it is easy to make money with futures. In the morning time, you can focus on either SPX or earnings like that. Yeah. That's it, everyone. Hope both the sessions helped you to understand how, if we follow a proper system, you are not trading with a FOMO or you are not trading. Now you know why you are taking a trade. You will have more confidence. You can, otherwise, your emotions will play, right? If you don't know why you are taking a trade, suddenly you buy something, suddenly you see red candle, you immediately get panic, you sell it, and immediately it will start going up. Or you short something, suddenly you see a green candle, you get panic. You take stop loss, immediately it will start dropping. That's what happens when you don't understand why you are taking a trade. But once you understand, once you follow a proper system, then you will be more confident, comfortable, and you can make bigger profits. That's what happens when you take time to learn practice. And then yeah, you don't need to worry about job market situation, or you don't need to worry about visa situation or anything, because SPX or futures, earnings, anything you can do from anywhere. Even though you are not in US also, you can do all these things from anywhere, or prop firm trading. So you are creating a plan B suddenly because of AI, because of Trump immigration rules, whatever it happens, you already have a plan B set aside. So you don't need to worry about, because especially in IT market, we cannot say that we'll work until 60, 65, right? Even 45, 50 itself, you are too much over experienced for that role. Instead of paying a 20-year, 25-year experienced guy, they can hire some 2-year, 3-year experienced, pay 50% of your salary. They can get the work done. Or they can use some AI technology, which is doing most of developer jobs, tester jobs, support jobs, everything. AI is doing most of the stuff. They need only 10% of the staff now, the who can use the AI and get the work done. So that's why it is better you have a plan B, whether trading or something else, but have plan B so that you don't get surprised if there are any massive layoffs in your company or anyone's company. So yeah, that's it, everyone. We'll talk again at 6 p.m. where I explain what are prop firms, how to use the indicators. We'll also, because futures market opens at 5 p.m., I can also show you with the live trades how we are making $400-500 every day in the evening time. Bye, everyone. Have a nice rest of the day and all the best.